Breaking news is hitting the US auto market right now, and it is not coming from Detroit, Silicon Valley, or a Chinese EV startup. It is coming from Mazda, a brand long seen as conservative, disciplined, and quietly premium. And this move is sending shockwaves through dealerships, boardrooms, and Wall Street trading floors all at once. Mazda has just rolled out massive, aggressive price discounts across key models, and this is not a routine seasonal incentive. This is a strategic bombshell that signals something much bigger unfolding beneath the surface of the American auto industry. So the first question everyone is asking is simple but unsettling. Why is Mazda doing this now? Mazda is not a brand known for reckless discounting. For years, it positioned itself as a near-premium alternative, focusing on design, driving dynamics, and quality rather than price wars. But the reality on the ground has changed dramatically. Inventory levels across the US are rising fast, consumer demand is cooling, and interest rates are crushing monthly payments. Mazda is facing a market where buyers are hesitating, financing is tightening, and competitors are cutting prices aggressively. This is not about greed or generosity. This is about survival, market share defense, and staying relevant in a rapidly shifting landscape. Behind these discounts is a deeper pressure point that many automakers do not want to publicly admit. The post-pandemic pricing bubble is deflating. Consumers are no longer willing to overpay. Dealers are sitting on unsold vehicles longer than expected. Mazda, which lacks the massive cash reserves of Toyota or the pricing power of luxury brands, is choosing to act early instead of reacting late. These discounts are Mazda reading the warning signs and deciding to move first rather than be forced later. But here's where things get interesting, because there is always a catch. The discounts look incredible on paper, but they are not free money. Some are tied to financing conditions, dealer participation, regional inventory imbalances, or specific trims that are not moving. Others quietly replace previous incentives instead of stacking on top of them, and in some cases the base MSRP stays high while the effective transaction price drops only for buyers who qualify. Mazda is slashing prices, yes, but it is also carefully controlling where and how that pain is absorbed, often pushing it downstream to dealers rather than corporate balance sheets. This move immediately ripples across the entire US auto market. When a brand like Mazda drops prices aggressively, competitors cannot ignore it. Honda, Toyota, Hyundai, and even Ford are now forced to reassess their own pricing strategies. A consumer who sees a discounted Mazda CX-5 or Mazda 3 suddenly questions why a similarly sized competitor still costs thousands more. This creates a domino effect where one brand's discounts pressure others to follow, even if they are not ready. Price discipline starts to break, margins shrink, and the industry inches closer to a full-scale pricing reset, and Wall Street is watching very closely. Investors do not like uncertainty, and they especially do not like margin erosion. Mazda's move reinforces fears that automakers will sacrifice profitability to maintain volume. Analysts see this as confirmation that demand is weaker than public statements suggest. Stock prices across the auto sector tend to react not just to one company's decision, but to what it signals about the entire industry. If Mazda is cutting this deeply, investors ask who is next and how bad things really are behind closed doors. For consumers, the reaction is immediate and emotional. Buyers feel validated for waiting. Those who purchased recently feel frustrated. Shoppers flood dealerships expecting even deeper discounts, not just from Mazda but from everyone else. Trust in MSRP collapses further. Consumers begin to believe that prices are artificial and negotiable again, reversing years of pandemic era take it or leave it pricing. This shift changes buyer psychology in a powerful way, slowing purchases as people wait for the next drop, the next incentive, the next desperate move. What makes this moment especially dangerous for the industry is that it feeds on itself. Discounts bring buyers in, but they also train buyers to wait. Waiting weakens demand. Weak demand forces more discounts. And suddenly, automakers are no longer controlling the market narrative. The market is controlling them. Mazda's decision is not isolated. It is a symptom of a broader correction that many insiders quietly feared but hoped to delay. And as this pricing shock spreads, it raises a much bigger question that no automaker wants to answer out loud. If brands known for restraint are now slashing prices, what happens when the heavily leveraged, high-cost players have no choice but to follow? Because once this door is opened, closing it becomes almost impossible, and the next phase of this story could reshape the US auto industry in ways most buyers and investors are not prepared for. The real danger is not the discount itself, but what it reveals about the underlying health of the market. Mazda's move is a signal flare, not a one-off promotion. It suggests that demand forecasts written just months ago are already obsolete. Automakers built production plans assuming buyers would tolerate higher prices indefinitely, but that assumption is now collapsing in real time. As more vehicles sit unsold on lots, the cost of doing nothing becomes higher than the cost of cutting prices. And Mazda has chosen to absorb the shock early rather than let inventory become an anchor dragging the brand down. Dealers are now caught in the middle of this shift, and that pressure is intense. On one side, Mazda corporate wants volume, visibility, and momentum. On the other, dealers are staring at thinner margins, higher floor plan interest costs, and customers who are suddenly more aggressive at the negotiating table. This tension is critical because it reshapes how vehicles are sold, not just how they are priced. Sales strategies shift from scarcity to urgency, from premium positioning to value messaging, and once that transition happens, reversing it is extremely difficult. Competitors are studying Mazda's playbook closely. Some will quietly match discounts without advertising them. Others will repackage incentives as loyalty bonuses, conquest cash, or special APR offers to avoid headline price cuts. But the end result is the same. Transaction prices fall, profit per unit shrinks, and the industry enters a margin compression phase. This is exactly the scenario Wall Street fears most, because volume growth without profit growth is not growth at all. From an investor standpoint, Mazda's decision raises uncomfortable questions about balance sheets and long-term strategy across the sector. If pricing power is weakening, automakers must rely on cost reductions, platform sharing, and supplier pressure to protect earnings. That often leads to cutbacks, delayed investments, and slower innovation. Wall Street starts recalculating risk, re-rating stocks, and shifting capital away from automakers towards sectors with more predictable returns. This is how pricing decisions on dealership lots end up influencing trading activity in New York within hours. Consumers, meanwhile, are becoming more strategic than ever. Buyers are comparing brands side by side, not just on features, but on who is blinking first. Mazda's discounts force consumers to ask whether now is the perfect time to buy, or whether even bigger cuts are coming. That hesitation alone can freeze demand temporarily, making the situation worse before it gets better. The market enters a waiting game, and waiting is poison for high-volume manufacturing industries. There is also a psychological shift happening that cannot be ignored. Mazda built its recent reputation on refined interiors, upscale design, and a feeling of attainable luxury. Aggressive discounting risks diluting that image. Once consumers associate a brand with deals rather than desire, rebuilding premium perception takes years. Mazda is betting that the short-term volume boost outweighs the long-term branding risk, but that is a gamble with real consequences if the market downturn deepens. What makes this moment even more volatile is the broader economic backdrop. Interest rates remain elevated, household budgets are stretched, and insurance and maintenance costs are rising. Even with discounts, affordability is still a challenge for many buyers. That means incentives must work harder just to move the same number of vehicles. Each round of price cuts delivers diminishing returns, increasing the likelihood that further reductions will be required to maintain momentum. And this is where the story begins to shift from pricing to power. Whoever controls pricing momentum controls consumer expectations. Mazda has just pushed the market in a direction it may not be able to pull back from. Other automakers will be forced to respond, not because they want to, but because standing still now looks like weakness. The question is no longer whether more discounts are coming, but how fast they will spread, how deep they will go, and which brands will absorb the most damage as this new phase of the US auto market continues to unfold. As this momentum builds, the competitive hierarchy of the US auto market begins to shift in subtle but powerful ways. Brands that relied heavily on brand loyalty and perceived value now find those advantages under pressure. When a consumer can cross-shop a discounted Mazda against a higher-priced rival, loyalty starts to erode. Buyers become more transactional, less emotional, and far more analytical. This environment rewards brands that can move quickly and punishes those trapped by rigid pricing structures or bloated cost bases. Mazda's strategy also exposes a growing divide between manufacturers with flexible global supply chains and those locked locked into expensive domestic production. Companies with higher labor costs, complex union agreements, and slower production adjustments face greater pain when prices fall. Mazda, sourcing from a mix of global plants, can maneuver faster, at least in the short term. That flexibility is now becoming a competitive weapon, and Wall Street is recalculating which automakers can endure a prolonged pricing battle and which cannot. The ripple effects are already visible in dealership behavior. Sales managers are adjusting scripts, advertising shifts toward monthly payment relief instead of features, and urgency messaging is creeping back into showrooms. The phrase limited availability is quietly disappearing, replaced by limited time savings. This language change matters because it signals a return to a buyer-controlled market. Consumers feel the power dynamic shifting, and once that perception takes hold, it reshapes the entire buying cycle. At the same time, used car values begin to feel the pressure. When new vehicles become cheaper, the justification for inflated used prices weakens, trade-in offers soften, auction prices wobble, and residual values come into question. This creates another feedback loop that impacts leasing strategies, fleet sales, and even insurance valuations. Mazda's pricing decision does not stop at new cars, it bleeds into every corner of the automotive ecosystem. Wall Street analysts are now dissecting earnings models with a sharper knife. Revenue forecasts based on stable pricing assumptions no longer hold. Even small price cuts, when multiplied across hundreds of thousands of vehicles, translate into massive revenue shifts. This forces analysts to downgrade outlooks, adjust target prices, and in some cases exit positions altogether. Volatility increases, and auto stocks become more reactive to headlines than fundamentals, a dangerous place for long-term investors. Consumers, watching all of this unfold, start to behave differently as well. Some rush in, fearing the deals may vanish. Others hold back, convinced this is only the beginning of deeper discounts. This split reaction creates uneven demand patterns that make production planning even harder for automakers. Factories cannot easily slow down without consequences, yet overproduction in a soft market accelerates the discount spiral. Mazda's move also pressures automakers that invested heavily in electrification and advanced technology. High R&D costs demand strong margins to justify them. If pricing power erodes across the industry, those investments become harder to sustain without government support or strategic partnerships. This could delay model launches, reduce feature content, or force automakers to prioritize profitability over innovation, reshaping product roadmaps across the next several years. What is unfolding now is not just a pricing story, but a structural stress test. The US auto market is being forced to reveal which business models are resilient and which were built for an era of cheap money and endless demand. Mazda has fired the opening shot, intentionally or not, and the industry is now reacting to a reality it can no longer ignore. Each discount, each incentive, each pricing adjustment adds pressure to a system already under strain, and the consequences of this shift are only beginning to surface as the market moves deeper into this new phase of uncertainty and competition. The longer this environment persists, the more it exposes vulnerabilities that were previously hidden by strong sales and inflated pricing. Automakers that expanded aggressively during the boom years now face excess capacity, and excess capacity in this industry is unforgiving. Plants cannot be idled without political, financial, and labor consequences. Mazda's price cuts indirectly shine a spotlight on this issue because once pricing pressure begins, volume becomes the only lever left to pull, even if that volume comes at the expense of profitability. This is where the conversation turns from strategy to consequence. If discounting becomes normalized, brands that cannot keep costs low will be forced into painful decisions. Cost-cutting accelerates, supplier contracts are renegotiated, and future investments are postponed. Wall Street recognizes this pattern instantly, which is why even a single manufacturer's pricing decision can trigger broad market anxiety. Investors are not reacting to Mazda alone. They are reacting to what Mazda's behavior implies about demand across the entire sector. Dealers, meanwhile, start preparing for a very different kind of year. Marketing budgets are reallocated toward digital ads, emphasizing price, rebates, and payment calculators. Inventory aging becomes a daily concern instead of a monthly one. Sales tactics shift toward closing deals quickly rather than building long-term relationships. These changes affect customer experience in subtle ways, reinforcing the perception that the market has tipped decisively in favor of buyers. Consumers feel that shift immediately. Negotiation confidence rises rises. Shoppers walk into showrooms armed with screenshots, competitor quotes, and the expectation that everything is negotiable again. Even buyers who do not choose Mazda benefit from Mazda's move because it weakens pricing discipline across the board. This is how a single brand's discount strategy quietly reshapes consumer behavior far beyond its own dealerships. Another underappreciated impact is how this affects financing and lending. As vehicle prices fluctuate, lenders become more cautious about residual values and default risk. Credit standards tighten, promotional APR offers become more selective, and subprime buyers face higher barriers despite lower sticker prices. This limits the effectiveness of discounts and creates friction in the very segments automakers rely on for volume, adding another layer of complexity to an already unstable market. Mazda's decision also alters the internal calculus of competing automakers. Executives are forced to choose between protecting brand image and protecting sales numbers. Delay too long and inventory piles up, react too quickly and margins collapse. There is no perfect answer, only trade-offs. That tension is now playing out in real time across boardrooms, with pricing committees under pressure to respond before the market moves further against them. As this unfolds, the broader narrative around the US auto market begins to change. For years, the story was about shortages, wait lists, and record profits. Now the story is about incentives, affordability, and defensive moves. Mazda's bombshell accelerates that narrative shift, making it harder for automakers to maintain optimistic messaging while quietly cutting prices behind the scenes. What happens next depends on how far this pricing wave travels and how long it lasts. If discounts remain targeted and temporary, the market may stabilize. But if competitors escalate, if incentives stack, and if consumer expectations lock into a lower price mindset, the industry could be entering a prolonged adjustment period. Mazda has already crossed the line that many hoped would hold, and the implications of that choice will continue to ripple outward as the US auto market navigates a landscape that is becoming more competitive, more uncertain, and far less forgiving with each passing month. Dealers, meanwhile, start preparing for a very different kind of year. Marketing budgets are reallocated toward digital ads, emphasizing price, rebates, and payment calculators. Inventory aging becomes a daily concern instead of a monthly one. Sales tactics shift toward closing deals quickly rather than building long-term relationships. These changes affect customer experience in subtle ways, reinforcing the perception that the market has tipped decisively in favor of buyers. Consumers feel that shift immediately. Negotiation confidence rises. Shoppers walk into showrooms armed with screenshots, competitor quotes, and the expectation that everything is negotiable again. Even buyers who do not choose Mazda benefit from Mazda's move because it weakens pricing discipline across the board. This is how a single brand's discount strategy quietly reshapes consumer behavior far beyond its own dealerships. Another underappreciated impact is how this affects financing and lending. As vehicle prices fluctuate, lenders become more cautious about residual values and default risk. Credit standards tighten, promotional APR offers become more selective, and subprime buyers face higher barriers despite lower sticker prices. This limits the effectiveness of discounts and creates friction in the very segments automakers rely on for volume, adding another layer of complexity to an already unstable market. Mazda's decision also alters the internal calculus of competing automakers. Executives are forced to choose between protecting brand image and protecting sales numbers. Delay too long and inventory piles up, react too quickly, and margins collapse. There is no perfect answer, only trade-offs. That tension is now playing out in real time across boardrooms, with pricing committees under pressure to respond before the market moves further against them. As this unfolds, the broader narrative around the US auto market begins to change. For years, the story was about shortages, wait lists, and record profits. Now the story is about incentives, affordability, and defensive moves. Mazda's bombshell accelerates that narrative shift, making it harder for automakers to maintain optimistic messaging while quietly cutting prices behind the scenes. What happens next depends on how far this pricing wave travels and how long it lasts. If discounts remain targeted and temporary, the market may stabilize. But if competitors escalate, if incentives stack, and if consumer expectations lock into a lower price mindset, the industry could be entering a prolonged adjustment period. Mazda has already crossed the line that many hoped would hold, and the implications of that choice will continue to ripple outward as the US auto market navigates a landscape that is becoming more competitive, more uncertain, and far less forgiving with each passing month. Consumers are not just reacting to prices, they are reacting to tone. The moment brands start talking about value instead of innovation, buyers sense a shift. Mazda's pricing bombshell changes that tone across the industry. Marketing narratives pivot away from cutting-edge features and toward affordability, reliability, and total cost of ownership. This reframing signals that the era of easy pricing power is over, at least for now. The long-term impact could extend beyond sales and into brand identity. If Mazda succeeds in using discounts to capture market share without permanently damaging its image, others will follow. If it struggles, competitors will hesitate, but the pressure will not disappear. The industry is being forced to experiment in real time, with millions of dollars at stake in every pricing decision. What is certain is that this moment marks a turning point. The US auto market is no longer driven by scarcity and unchecked demand. It is being reshaped by affordability constraints, cautious consumers, and aggressive pricing tactics. Mazda did not create these conditions, but it has chosen to confront them head on. And as the market continues to adjust, every new incentive, every price cut, and every strategic response adds another layer to a story that is still unfolding, with consequences that will continue to evolve as this pricing battle intensifies. As this pricing battle matures, the final outcome becomes less about who offers the biggest discount and more about who survives with their business model intact. Mazda's move forces a reckoning across the industry, separating brands that can adapt quickly from those that depended on inflated margins to mass structural weaknesses. The companies that emerge strongest will be those that align pricing with real consumer affordability while maintaining cost discipline behind the scenes. For Wall Street, the message is now unmistakable. The era of easy auto profits is fading, replaced by tighter margins, heavier competition, and a renewed focus on execution rather than hype. Investors will reward resilience, not volume at any cost, and punish companies that chase sales without a clear path to sustainable profitability. Mazda's discounts have become a data point that analysts will reference for months as they reassess the entire sector.